Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Investors shrugged off a 2.53% gain for the weekend of January 4th, 2012. Just realizing that there is really no resolution to the European debt crisis. They ignored some really good numbers. We had strong post-holiday shopping. We had good December car sales. But again, they were just willing to take a little bit more off the table as they got into the kind of doldrums the last 2 weeks. Now, everybody's heard about the Santa Claus rally that goes on. And in fact, it happened to be true this holiday season, again, with 2.53% return. But what we saw was actually outflows from the particular groups. Let's take a look at the macro groups to see where people were pulling money from. If we take a look, equity funds saw about a $2 billion outflow. That's not too unusual. We've been having a lot of outflows out of equity funds. People have been very concerned. Taxable bond funds took in about $800 million, not that much to write home about. Muni bond funds, though, had a pretty good turnaround, $500 billion in inflows, and money market funds saw about $2.6 billion in outflows. So that's how we got to that minus $3.3 billion in outflows for the week, again, out of the conventional fund business for the weekend of January 4th, 2012. Well, if we take a look at equity funds, we might get a little bit of a head scratcher. We actually had a 2.53% return, but we saw about $2 billion flow out of the coffers of equity funds. And this is the 9th consecutive week that we've seen outflows. So people have been very, if you will, dour on equity funds and really pro on fixed income funds. We'll get there in a second. If we take a look at the domestic equity funds, we saw about $1.1 billion in outflows, and non-domestic equity funds saw about $900 million in outflows. But equity income fund, once again, saw just a little bit shy of $600 million on the inflows, and that's been quite a story. We've been seeing people going after the equity funds that are paying dividends, and equity income funds is one of our big classifications. It's really taken the lion's share of all the flows for equity funds when we're looking at the equity fund universe. Ironically, if we take a look at equity funds and include ETFs in this, we actually end up with slightly worse numbers. Equity ETFs saw about $800 million in outflows, but particularly when we were taking a look at it, SPY saw about $1.1 billion in outflows. So it's been a little bit contrarian to what we've been seeing lately. Usually it's been flows out of money or out of equity funds on the open end side, but flows under the positive flows for those of ETF funds. That just didn't turn out to be this week. And I think people, again, were just kind of sitting on their hands. It was a holiday season, and a lot of people, I think, were just off the trading floor. Well, if we take a look at where some of the money has been going recently, we take a look at fixed income funds. Fixed income funds for the third consecutive week saw inflows about $0.8 billion, $800 million. It's the third week in a row that we've actually seen positive returns in that area as well. We saw about a 0.85% return for the week. Certainly nothing to sneeze about. 0.85% for 1 week return is absolutely phenomenal, actually. Where we saw most of the money going, though, again, was in corporate investment grade debt funds. They saw about $500 million in inflows, and that's been kind of the story we've been talking about. People taking that intermediate area. So they've been an intermediate investment grade, not going very long on the scale, not going short, not taking on too much risk, but not taking on too little risk either. So it's just about right. Government mortgage funds also saw about $300 million, really want to put billion in here, $300 million in inflows, and that's been, again, a story we've been talking about for quite some time, is right in that middle area, and maybe a little bit towards less risk has been where the money's been going as of late. Well, one of the things that we want to take a look at always is muni bond funds, and it's because we've had such a weird story for 2011 with the Meredith Whitney basically calling for the demise of muni bond funds. Over the last 7 weeks, we've actually seen positive returns for them. In fact, this week we saw a 0.49% return, and we saw the 5th consecutive week of inflows. And we saw about $458 million come into the coffers of muni bond funds. In particular, investors actually focused on national munis, which saw $417 million in net new money. So that's been kind of the story where we've been seeing. People have been saying, hey, listen, you can get a great deal on muni bond funds. They have gotten beaten up over the years, and their yield has been quite high relative to similar risky taxable bonds as well. So people have been getting a better yield, a little bit bigger kicker as far as return on their equity. You're putting money in, and then also they've been looking at something that's probably got a little bit more safety because it already got beat up. So people have been putting money away in muni bond funds. Well, now we take a look at the money market funds, and we can actually see where a lot of the money actually flew out of. We had $2.6 billion in outflow. It's the 2nd consecutive week of outflows. And when we take a look at a taxable money market fund, saw $7.8 billion leave their coffers. This was actually instigated by institutional investors. $9.7 billion was pulled out by institutional investors versus $1.9 billion from retail investors going in. Well, that makes total sense to us. At the end of the year, that's exactly what corporate treasurers are doing. They sock money away at the last, during the last month, so they can meet those obligations at the month and quarter end, and especially year end. And that's particularly what they did this time. They actually took money and put it to work, if you will, for a couple of days, and or a couple of days last part of the year, and now they're pulling it back out. So $9.7 billion in outflows. If you take a look at tax-exempt money market funds, though, this is where we saw kind of a dichotomy. $5.2 billion in net new money came into tax-exempt money market funds. Again, this is one of the things that's not really head scratcher at all. If you think about it, it's the end of the year, people are sticking money away, and at the end of the year, everybody becomes a little bit more tax conscious, right? We're all preparing our tax returns. Well, that's going to be it for us this week. But before I get into anything else, I'm going to tell you that we expect some good moves over the next several weeks. I mean, we had a better than expected December ISM non-manufacturing number, came in about 52.6. That's expansionary. And we also saw non-farm payrolls this morning come out. 200,000 on net new jobs coming in, and that was absolutely great. Unemployment dropped to 8.5%. So this is something that we think can give the market a little bit of legs in the beginning days. A lot of people are calling for some good moves over the next couple of months, and maybe getting prepared for sell in May and go away. But for the first maybe a couple, 3 months, we're hoping we see some good numbers. Well, if you want to do more research, find out what areas where the flows are going for the areas that you particularly are focused in, you can go to our website. It's lipperusfundflows.com. And if not, you can meet us here next week where one of our analysts will talk about flows. Well, until next time, by the way, Happy New Year to you all. Until next time, my name's Tom Roseen, wishing you the best in your wealth planning and creation.